Hello, everyone. Good evening, or good morning, or good afternoon, depending on which time zone you're catching me from. It's great to see all of you here again on day 3 of Beat the Market. And let me share my screen before we go further. There we go. So if you can hear me and you can see my slides in front of you, do me a favor and let me know. Type yes into the chat box and let me know where you're from. So we've got Singapore, we've got Malaysia, we've got Kansas, we've got KL, Turkey, Hong Kong. I see Canada, I see the US, I see many parts of the US, Washington State, Toronto, Nigeria, Vancouver, Puerto Rico, Johor. Someone said Mars. Are you Elon's friend? Australia, India, Pakistan, a couple from California, New York. All right, wonderful. So Bahamas, wonderful. I love the Bahamas. Finland, San Diego, California. Okay, great. So I believe that many of you are here today because you want to create another source of income for yourself, trading the financial markets, whether from home or in fact anywhere in the world, right? So today I'm going to share with you what are the keys to high probability trading. What are the keys? Give me a second, sorry. What are the keys to high probability trading? In a way to achieve consistent probability or consistent profitability, sorry, right? And again, the strategies you're going to learn today, the concepts apply not just to trading stocks, although my main focus will be on trading stocks. But how do you apply the same concept to trading options, currencies, even cryptocurrencies, which I don't trade personally, but some of you do, and CFDs, for example. In fact, there are many times when I identify a high probability trade, I will trade it using options very often as well. But of course, if options are not available, I will trade it with the stock itself. Yeah. So there's a lot to learn today. Give me a second. For some reason, hold on. This is really coming in. Apologies for that. Okay, sorry. Where was I? Yeah, a bit distracted there. So, like I said, take lots of notes. If you have questions, do post your questions on the Q&A chat, and I'll do my best to answer as many questions as I can during the Q&A session at the end of the webinar. All right? And at the same time, remember that all our courses and playbooks are going at 60 to 70% discount. Massive sale during this short period of time. So take advantage of the packages and grab them while they're still available. All right? So with that, let's begin. Let's get going. Now, how many of you attended my webinar on the first day where I talked about how to invest in the top 1% of companies in the world and how to beat the market by investing in the top 1% of companies and buying them when they're undervalued? You guys caught that? Fantastic. All right. So today's webinar will be on short-term swing trading as opposed to my first webinar, which was on investing. So what's the difference? So before we begin, understand that investing and trading are two totally different approaches to the market. They are two totally different games. It's as different as golf and basketball. They're two totally different games. I mean, they both involve putting balls in holes, right? You can make a lot of money as a professional basketball player or golf player, but they have got very different set of rules, correct? Same thing with investing and trading. And the best analogy that I can give is that investing is like getting married. And you only want to marry the best people, right? But trading is like an affair. It's like a one-night stand. So again, when you have an affair and one-night stand, you don't need the person to be like really intelligent or responsible or hardworking or great value system. No, as long as the person is hot for a short period of time, you go for that swing trade, if you will. Okay, so very, very different. So before we learn about high probability trading today, how to achieve consistent profits trading the markets, let me do a very clear distinction between investing and trading, okay? So again, remember that for investing, we only want to buy the top 1% of the fundamentally strongest stocks in the market, the best of breed, or investing in REITs for some of you, okay? And we only want to buy these great companies only when they are undervalued, correct? Now, at the same time, how many of you realize that there are some stocks which may not have good businesses? They may not be making money, but the price could still go up. How many of you realize there's some stocks like that? The business is losing money, but the price can still go up. Or certain stocks could be way overvalued, but they still go up. Have you realized that? And some stocks may be good companies, but temporarily they could still collapse because of panic and manipulation and news, right? So could we also make money on those 99% of stocks that may not be good companies, but they go up because of hype, because of manipulation, because of news? Example, meme stocks like your GameStop, for example, or even DJT, where the business is losing money, but the price goes up whenever Trump wins something, right? So all these kind of stocks, fundamentally, the business is crap, but the price could still go up because of, again, emotions, manipulation, and news, yeah? So could we make money on those stocks? Yes, but only as a trade, not as an investment, as a short-term swing trade, as an affair, as a one-night stand. So for trading, we can trade the other 99% of crap stocks. I call them slut stocks, crap stocks, right? I wouldn't invest in them, but one-night stand, affair, okay, get in, get out fast, don't stay too long, or you may get killed, all right? We can also trade other assets like options. We can trade currencies. You could trade crypto if you want. Okay, you could trade futures. You could trade anything under the sun. Okay. So for investing, the main focus, I would say 90% of the focus for investing would be on fundamental analysis. Fundamental analysis, which is focusing on the underlying business. And again, the idea is to buy low and sell high, to buy when it's undervalued and to sell when it's way overvalued. But trading is different. In trading, 90% of your focus is on the short-term price action. It's on the price movement. As long as it looks like it's going up, we go in for a buy. As long as it looks like it's going to go down, we go in for a sell. We don't care about the business. We don't even need to know what the business is doing, all right? It's like if you have an affair or one-night stand, which you shouldn't in real life, okay? But if you did, you don't really care about this person's background or family, right? You're just going for that one-night stand based on the short-term price action. And so in trading, we don't care about intrinsic value. We don't care if it's undervalued or overvalued. We don't care about it. In fact, even if the stock is way overvalued, expensive can get even more expensive. High can go even higher. So in trading, we can always buy high and sell even higher. So I like to call trading the greater fool's game. The greater fool's game. Like for example, if you buy something expensive or you buy something that could be worthless, like some meme coin, to me, if you buy it, you're a fool. You are a fool, but it's okay as long as you sell it to an even bigger fool than you, who's willing to pay a higher price. And that bigger fool who bought it from you must sell it to an even bigger fool who's willing to pay a higher price. And the game goes on and on until the biggest fool pays the highest price and no one else wants to buy and the thing collapses. All right? Okay. Now, investing, when you invest in a stock, for example, you must always take a medium to long-term view. A medium to long-term view. So whenever I invest in a business like Nvidia, like Microsoft, like Apple, I'm taking a medium to long-term view of at least 3 to 5 years or even 10 years. Okay. Now, does that mean Does that mean that I can only make money in 3 years or 5 years or 10 years? No, it doesn't mean that. In fact, there are many stocks I invest in where the moment I buy, the next day or the next week, the price is way higher than what I bought it for, right? I'm already seeing a lot of unrealized profit, right? But the only thing is I don't sell so fast. I don't take profits so fast because as an investment, I'm not interested in a 10% return. I'm not interested in a 20% return. I'm not even interested in a 50% return. When I invest in a stock, I'm looking to 3x, 5x, 10x my money. You see what I'm saying? For example, when I bought NVIDIA at $150 before the share split, I bought it in October and November 2022. And from $150, right, it went all the way to $1,000. I did sell it temporarily, but I bought it back. Now it's over $1,000. After the share split is like $115. Am I selling? No. So even though I have made a few times profit, I'm not selling because for NVIDIA, I'm taking a long-term view. I'm holding it for the next 3, 5, 10 years because I want to 5x, 10x, 20x my money. You get the point? All right. But for trading is different. Trading, again, is a one-night stand, it's an affair. When we get in, we have a very short-term view. We're aiming to get out in a few days. That's it. Or at the very most, a few weeks. Got it so far? Yeah. Now, in investing, when you buy a great business that's undervalued and the share price drops 10, 20% below your purchase price, do you cut loss? In investing, you buy a great company, it's undervalued, but short term, it still goes down. Do you cut loss? No, you don't. If you cut loss, you are an idiot. You are an idiot, all right? Because if you know it's a great company, then you know that eventually it's going to go a lot higher. So if it goes down more temporarily, you don't want to sell. You're an idiot to sell. In fact, you should buy more because it allows you to buy more of a great company at an even bigger discount. So in investing, there's no stop losses. All right. In fact, you want to buy more as it goes down because it's the top 1% of the best companies in the world. These companies will always go up. Okay. But in trading, the moment you enter the trade and the price moves against you, you thought it's going to go up, but the price goes down, you have to cut loss ruthlessly. You have to cut loss quickly. Why? Because when you trade stocks, these stocks may drop and never come back because they may not be the top 1% of the best companies. They may be way overpriced. They may not be making money. You get the point, right? And at the same time, you cut loss fast. And if it goes in your direction, you must also take profits fast. See the difference? Yeah. In investing, your win rates are very, very high. Let me ask you this question. If you buy a great company like Microsoft, like Amazon, like Meta, like Google, when they are undervalued, okay, what is the chance that the stock will be higher in 3 to 5 years? What's the chance it will be higher in 3 to 5 years? I can tell you it's like close to 100%. It's close to 100%, 90 to 100%. It will be higher in 3 to 5 years. And if not, it will definitely be higher in 8 to 10 years. All right, it's like 100%. Okay. So in investing, the win rates are very high, very high. And there's less frequency of transaction because once you buy, you don't sell. You just sit on your ass and let the price compound your money. Okay. But trading, because you're getting in and getting out in a few days or few weeks, your win rates can't be 90 to 100%. Okay. So realistically, if you buy Amazon today or McDonald's or Celsius or Monster, what's the chance the price will be higher in 1 week? What's the chance you'll be higher in 5 days? Is it 90%, 100%? No. At the very most, if you get the technicals right, the probabilities right, your win rate is about 50 to 60%. Okay? I can tell you that the best traders in the world, their win rates are 50 to 60%. I know many professional traders who would sell their grandmother for a 60% win rate. okay? So in trading, your win rates are a lot lower, but there's more frequency. You get in, you get out, you get in, you churn a lot faster. Get a point? Now, the good news is that if you learn how to use options in your trading, especially what I taught yesterday. How many of you attended my options webinar yesterday, where I talked about selling cash secured puts and credit spreads? Okay, so if you use certain option strategies, you can get a 70 to 90% win rate for short-term trading, but only if you use options, because options allow you to profit even if the price doesn't go up, as I taught yesterday. Yeah. So if you missed my earlier webinars on options on investing, please catch the replay. You'll be sent the limited time replay link. Do watch those videos as well, right? Next difference. In investing, you only make money when the price goes up eventually, correct? Price goes down, obviously you don't make money. But the good thing is investing, it will always go up eventually if you buy great companies. But in trading, you can make money whether the price goes up in the short term or whether the price goes down in the short term. How? By, if you think the price is going to go up, you go long the stock, which means you buy low, sell high, or buy high, sell higher. If you think the price is going to go down, you can short the stock, which means short selling. You borrow shares from the broker, you sell the shares at a high price, then you buy the shares back at a lower price and return it to the broker. That's called going short. And I'll talk a bit more about it in a while for those of you who are totally new to trading. Yeah? In investing, what's the objective? The objective is wealth accumulation. It's wealth accumulation. You're looking to 5, 10x, 20x your money. Okay? But in trading, the focus is in short-term profits, right? 10% get out, 20% get out, 15% get out. Okay, so does that make it a lot clearer about investing and trading? How many of you are now clearer about this? Fantastic. And out of curiosity, how many of you before this webinar today, you thought investing and trading was the same thing? How many of you didn't even know there was a distinction? You're like, isn't it the same thing? Right? Great. So now you know. Okay. So great. Now that you know. Excuse me. All right. So for the benefit of those of you who are totally new to trading, let me share some very quick basics. Okay. So how do you make money from trading stocks? There are two ways to make money. Number one is by going long. Going long. What does going long mean? Going long means you buy a stock at a certain price in anticipation of selling it at a higher price. That's it. So buy low, sell high, or buy high, sell even higher. So for example, if you look at a stock and the price action is, for example, on an uptrend. So on an uptrend, you think there's a high probability the price will continue going up. So you are bullish. Bullish means you think the price will go up. So if you're bullish, what do you do? Oops, excuse me. If you're bullish, what do you do? You would say, let's say it's at $9. Let's say it's at $29 right now, the stock. So you would buy at 29. Okay. Now, when you buy something, money goes out. Money goes out, right? So when you buy at $29, you get a debit of 29. Debit. Okay. And after you buy it, let's say it really goes up to your profit target of, say, $36. And you decide to sell at 36. Okay. So when you sell, what happens? Money comes back. So it's a credit. So when you sell, you get a $36 credit. So what's minus 29 plus 36? Your profit is $7 per share. So you basically buy to open the position and then sell to close the position. So this one, I think everyone understands. Pretty straightforward. Yeah. Now, at the same time, you can also make money by going short. So going short is when you think the price will go down for whatever reason. For example, the price is on a downtrend or the business is losing lots of money. Okay. So if you think the price is going to go down, you are what? You are bearish. Okay. So if you're bearish on a stock, let's say this stock called GE, and GE is now at $26, for example. If you're bearish, what do? You sell, right? You sell GE at $26. But if you don't have the shares, can you sell at 26? How do you sell something you don't own? How do you sell something that you don't own? Yes, you can. It's called short selling. So when you click sell, and if you don't have the shares, the broker will lend you the shares in 1 second. Okay, the broker will lend you the shares. So you borrow the shares from the broker, and then you sell the shares at $26. So when you sell, it's a credit. Money comes to you, right? So there you are, you get a credit of $26. But remember, you borrowed the shares to sell it. Must you return the shares to the broker? Eventually, must you return the shares back to the broker, which you sold? Yes, you have to return the shares back, right? So you're hoping after you sell the shares, the price goes down as you anticipated to your profit target, which, for example, let's say it's $20. So what do? At $20, you decide to buy the shares back from the market, right? So when you buy at 20, money goes out because you're buying. So it's a debit. It's a debit. Okay. So credit 26, debit $20, you make a profit of $6. Ta-da! And when you buy the shares back at $20, you then return the shares to the broker. So the broker is happy, he got his shares back. You're happy, you made money. Okay, so that's called short selling. And as long as you've got a margin account, you can just sell short any stocks that you want. Okay, so these are two ways that we trade the markets. We either go long or we go short. Yeah. So because of that, in trading, there's a saying, there's no such thing as a good or bad market. There's no such thing as a good or bad market, because if the market is going up, is it a good market? If the market is going up, is it good? It's good if you go long, all right? But if you go short, then it's bad. But if the market is going down, is that a good market? If the market is going down, is that a good market? It's good if you go short, right? It's bad if you go long, yeah? So the whole point is there's no such thing as a good or bad market. There's no such thing as a good or bad stock, because you will profit as long as you trade in the direction of the price. So if the market goes up, you go long, market goes down, you go short, you make money in whichever direction. So this allows you to trade in a way that is recession-proof. You don't need the market to go up to make money. Whether you trade stocks or whether you trade options or you trade Forex. So trading is a lot more flexible, if you will, yeah? Okay, next. Let's talk about the reality of trading. By the way, how many of you here have traded before? You have been trading for a number of years. Okay, a couple of you. And how many of you are not as profitable as you would like to be? And you look at other people and you think, how are they so profitable and I'm not profitable? What are they doing differently? Do they pray to a special God? Can they see the future for some reason? Yeah. Now, one of the reasons why there are many people who are not profitable traders is because they've got the wrong perception of trading. They have been led to believe a lot of myths about trading. So before we start, let me dispel the myths and tell you about the reality about trading. Until you understand the reality, you'll be forever stuck in the matrix of lies and myths. And as long as you're stuck in the matrix, you will never be a consistently profitable trader. All right? So what's the reality versus the myths? Let's run through this. The first myth that a lot of retail traders have is that they believe that successful traders like Alson, like Bang, like myself, or whoever, right? Successful traders who make millions in the market is because they have a crystal ball. They've got a crystal ball. They're an oracle. They can predict where the price will go better than anyone else. Is that true? Can I predict where the stock market will go? Can I predict where this stock will go better than you, better than everyone else? The answer is no, I can't. I can't. I don't have a crystal ball, okay? So what is the reality? The reality is that successful traders cannot predict the market any better than you can. But what makes them different is that successful traders, they are able to identify high probability setups. I repeat, they only can identify high probability setups, and they are only disciplined to take high probability setups. That's the difference. Let me say, what's a high probability setup? Okay, so today's webinar, I'll be going to review what makes a high probability setup. It's a setup where the odds are tilted in your favor, where there's a high probability that the price will move in your intended direction. But there's no guarantees. There's no 100% because there's no way you can predict for sure because anything can happen in the markets. There are too many moving parts, right? So all we can do is to trade based on probability, okay? That's number one. Number two, second myth is successful traders win all the time. They never lose. They only win, or they got very high win rates. Is that true? Well, I already told you earlier on, it's not true, right? And the reality is that successful traders, they only win 50 to 60% of the time. They only win 50 to 60% of the time. How many of you have heard of Richard Dennis? I'm just curious. Richard Dennis. If you have not, go Google, go read about him, right? So Richard Dennis, he's now retired, but he used to be one of the greatest traders in the world back in the 70s and the 80s. And Richard Dennis started with, if I'm not wrong, I think about $2,000 or $5,000, and he grew it to like $100 million. Okay, Richard Dennis. Okay, he's one of the best traders in the world. And if you read about Richard Dennis, can you guess what was his average win rate? Can you guess what was his average win rate? His average win rate was only 35%. Only 35%. So in other words, out of 100 trades, he would only win 35 trades on average, right? And he would lose 65 trades. But despite that, he made hundreds of millions. Why? Because the 65% of trades that were losing, he cut loss very fast. So he lost very little of those 65%. But the 35% of the trades that were winning trades, he was able to ride the trend and make so much to cover the losses of the 65%. Get a point? Another one of the best traders in the world is, of course, George Soros. And of course, he's a bit controversial politically, but George Soros, as you know, is the man that broke the Bank of England. He's one of the top currency traders in the world. And George Soros, same thing. If you study George Soros, his trading win rate is less than 50%. Less than 50%. But what did he say? He said, it's not whether you win or lose in trading that's important. It's how much you make when you are right and how much you lose when you are wrong. As long as you lose less when you're wrong and you make more when you're right, you'll be consistently profitable. You get the point? Okay? So, in other words, the key to consistently profitable trading is to ensure that the profits that you make from winning trades exceed the losses from losing trades. Because you will have losing trades. You will have losing trades. Okay? So your winning trades must make enough to cover those losing trades in order to make a profit. Got it? Yeah, Richard Dennis was more of a futures trader. That's right. But it's the same thing. Whether you're trading futures or currency or crypto or stocks, it's the same concept. Okay. So because of this, you have to ensure that when you enter a trade, you always enter 3 orders at one go. So when I teach my students, I tell them that when you enter a trade, you always have to know your entry price, your stop loss price, and your take profit price. We call it the 3 points to every trade. And no matter which broker you use, you should be able to enter all 3 trades together. It's called a bracket order. Out of curiosity, how many of you currently are already doing this? When you enter a trade, you got an entry price, stop loss, profit target, go in. How many of you? Fantastic. If you're already doing that, you are way ahead of 90% of traders who have no idea what they're doing, okay? How many of you have not done this before? How many of you have, in the past, entered a trade? It's like, I don't know. I don't have a stop loss. What's a stop loss? Profit target? I don't know. Okay. How many of you don't have that? Okay, you gotta have that, right? So when you take a long position, in other words, if you think the price of the stock is going to go up, you enter a buy order. Let's say in this example, you enter buy order at $90. You have to place a stop loss together with the buy order. You have to enter it together. So let's say the stop loss is at $87. Now, some of you will be wondering, how do I know where to put the stop loss? Why 87? Why not 85? Why not 70? Great question. So later, I'm going to show you where to place your stop loss in it at an intelligent level. Okay, so later we'll cover where to place stop losses. Right? But for now, let's assume you buy at 90, your stop loss is at 87. Okay, this from $90 to 87, we call this your 1 hour distance. It's called your 1 hour distance. Now, can you guess what R stands for? Can you guess what R stands for? R stands for risk. That's right, risk. So in this case, what's the 1 risk distance? The 1 risk distance is $3, right? So in other words, every share you buy, you're risking $3 per share. Okay? Now, then your next question will be, Adam, how many shares do I buy for this trade? So later I'm going to show you how to calculate the number of shares to buy using a formula. There's a certain formula. We call it position sizing. And you must calculate the number of shares to buy in a way such that you're risking about 1% of your entire capital. So my suggestion to most traders is every trade you enter, you risk 1% of your capital. So I'm going to show you again how to calculate to make sure that this happens. Now, some of you may be more aggressive and say, can I risk more than 1%? Sure, you could risk 2%, you could risk 3%, but my suggestion is do not go beyond 3%. If you go beyond 3%, you are insane. You are insane. Okay, eventually you're going to blow your whole account. So 1% to 3% would be a reasonable range. Now, some people ask me, can I risk less than 1%? Yeah, you can. You can risk 0.5% if you want. Okay, whatever. Okay, but the whole point is to be consistent. Yeah. Now, earlier on, what do we say? We say the key to profitable trading is to lose less when you're wrong and to make more when you're right. Okay, so you always want to ensure that your take profit distance is more than your stop loss distance. So in this case, if our risk is $3 distance, our profit should be more than $3, right? So usually we go for 1:2 risk to reward ratio. So if we're risking $3, we want to make at least $6. So for every 1 hour of risk, we want to make 2 hours of profit. Follow? Yeah. So what is $6 above 96? Sorry, what is $6 above 90? The answer, you will take profit at $96. Are we clear so far? Crystal clear? Great. Now, if you are going short, so in other words, you identify a stock and you think the price is going down, it's going to keep going down, I want to make money when it goes down, you short sell, okay? So when you short sell, let's say you are short selling a stock at 50 bucks, you're hoping it's going to go down. If it goes up, you lose money, right? So your stop loss has to be above your short entry, your sell entry. So same thing. When you're shorting a stock, you need 3 orders. The entry price, your stop loss, which is above the entry price, and your profit target, which is below the entry price. So in this case, you're selling at 50 bucks, you put a stop loss at 52. Again, you may ask, why 52? Why not 55? So again, later I'm going to show you where to intelligently put your stop loss. There's a certain formula that we use on stop loss placement, okay? But in this case, let's say $52. So again, what's our risk we're taking? What's our 1 hour distance? Our 1 hour distance would be $2, okay? So if we are risking 2, we want to make more than 2. We want to make, let's say, $4. So our profit target got to be $4 below 50 bucks. That's 46 bucks. Pretty simple, right? Okay. And for me personally, I like to take what I call a fire and forget approach. Fire and forget, which means once I enter a trade with my set stop loss and profit target, I don't look at it anymore. I leave it be, all right? So it either hits my profit target or it hits my stop loss. That's it. Simple. I don't interfere that much. If it hits a stop loss, I lose 1% of my capital. If it hits the profit target, I make 2% of my capital. Right? That's it. Very simple. Okay. And if you have the discipline, to always do this, will you make money? Yes, you will make money. Even if you are right half the time. Even if you're right less than half the time, you also make money. Why? Well, let's take a look at this. If you do 10 trades a month, that's 120 trades a year. And usually we do more than 10 a month. So this is just an example, okay? And if you have a win rate of 50%, okay, 50% win rate. Now, you should get more than 50% win rate if you take high probability trades. But let's say you're only right half the time. You're only right half the time, right? Which means that in 120 trades, you will have 60 wins and 60 losses. But if you control your risk to reward ratio from your predefined stop loss and profit target, each time you lose 1% of your capital. Again, later I'll show you how to calculate the number of shares so that you always risk 1% of your money. All right, that's later. Just hold on for a while, okay? And each time you win, you are gaining 2% of your capital, right? So 60 wins, 60 losses, net, that's 60% return a year or 5% a month. Is that not bad? A 60% return a year, is that not bad for a 50% win rate? Yes. So what's the point? The point is you don't need to have a high win rate in trading. You just have to control your risk to reward, okay? And as long as you take high probability trades, you should get within the vicinity of a 50% win rate. Even if you get below 50% win rate, like 40% win rate, you're still making good money, right? If you're really skilled and you can get 55, 60% win rate, you make a fortune. You make a fortune, yeah? All right, cool. Next, let's summarize. So the reality about trading, whether you're trading stocks, options, crypto, for whatever you're trading, okay? To be a winning trader, you must, number one, learn how to take high probability trade setups. Number two, know the right market conditions to trade which strategy. The trouble with some people is that they learn a strategy, but they don't know when to use that strategy. They trade it under the wrong market conditions. You have to wait. You have to wait for the market conditions to be right to trade that strategy. All right? Next, you always risk a small percentage of your capital in each trade that you take. So what did I say? What percentage of your capital should you risk? 1%. And if you're very aggressive, you should go up to at the most 3%. Don't ever go more than 3%. If you do, I guarantee it's a matter of time, you're going to blow your whole account eventually, right? And then most importantly is to manage your risk to reward, okay? By honoring your stop loss and your profit targets. Yeah? So far, is this useful, guys? Okay. So let's now learn how to identify high probability trades and how to assess the market condition. Like, is the market condition right to use this strategy? Or is the condition not right to use this strategy, right? So let's take a look at the next slide. So understand that whatever stock you look at, every stock will go through 4 stages in the market, 4 stages. And let me explain each stage. Stage 1 is what we call the broad consolidation stage. So during this market phase, you notice that the price is very choppy. Very choppy. The price goes blah, 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 right? It is very choppy, okay? And one way to know that you're in a stage 1 is look at the moving averages. Now, these are 3 of my favorite moving averages, although I use more, but these are the 3 main moving averages. The blue one is called the 50 moving average. Let me write it down. 50 simple moving average is the blue one. The green is the 150 simple moving average. And the red is the 200 simple moving average. Okay, so 50, 150, 200, all simple moving averages. Now, notice during the stage 1, which is the choppy phase, the high turbulent phase, okay, what's happening to the moving averages? What's happening to the moving averages? What do you notice is happening to the moving averages? They are crisscrossing. That's right. Can you see they are crossing each other? Okay. So whenever you see the moving averages are crossing like that, it's in stage 1. The stock is in a stage 1 phase, like that. Got it? Okay, cool. Now we know stage 1. Okay. Stage 2 or phase 2 is when a stock goes on an uptrend. When it goes on an uptrend. Now, how do you know it's in stage 2? How do you know it's in stage 2? There are 2 clues. Clue number 1 is you see the price making higher highs and higher lows. So you see this high here. Oops, sorry. You see the price makes this high, higher high, higher high, higher high, higher high, higher high, higher high. It makes higher highs. And it makes a low, a higher 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 low. So it makes higher highs and higher lows. That's the first clue, that you know it's in a stage 2 uptrend. The second clue is that in a stage 2 uptrend, what is happening to the moving averages? What is happening to the moving averages? The moving averages are generally sloping upwards. They're generally sloping upwards, and the 50 is above the 150, the 150 above the 200. Blue above green, green above red. Can you see that? Can you see that pattern? So that's the clue. Okay, that's the clue. Okay? Now, then stage 3 is called the topping phase. The topping phase. Now, how do you know it's a stage 3? How do you know it could be going to a stage 3? when you see the price moving 90 degrees. Now notice that in a stage one, generally, look at this, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. Generally is moving in a 45-degree angle. Can you see this called 45 degrees? 45 degrees, right? Once the price goes 90 degrees, like here, can you see it goes up 90 degrees here? That's called the topping phase. So when you see the price going up 90 degrees like that, we call that panic buying. Panic buying, because everyone says, we all want to stop, everyone's buying, right? And that creates that climax. It's like the grand finale. It's like, that's why Warren Buffett says a bull run is like sex. It feels the best just before it ends. So you've got a climax. All right? So when you see price going 90 degrees, that is topping phase. And that is when you don't want to buy. Never buy when you see the price going up 90 degrees, because the high chance is going to top and come back down very aggressively, right? So the first clue is when price goes up 90 degrees. Another clue is when the price starts to get far away from the moving average. Now, can you see the price here? Okay, let me zoom in a bit so you guys can see, right? Okay, let me zoom in here, okay? Now, can you see that the price is now far from the moving average? Is far from the blue line. Can you see that? So it's like when the price is very far from the moving average, it's like you're pulling the rubber band, and the rubber band will snap back, right? It will, the price will always go back to the moving average. It will snap back. So beware when it gets a bit too far from the moving average, you could be getting a topping phase. Yeah? Now, stage 4 is called the downtrend phase. Okay, this is called the downtrend phase. How do you know it's a downtrend phase? 2 clues. Clue number 1, price makes lower highs and lower lows. So you see this high there? High, lower high, lower high, lower high, lower high. Lower high. Then you see this low here, lower low, lower low, lower low, lower low. Okay, so this is a downtrend phase. Another clue is look at the moving averages. What's happening to the moving averages in a downtrend phase? The moving averages are all sloping down, right? It's sloping down, sloping down, sloping down, and the sequence is opposite. Now, the blue line is below the green line is below the red line. So the 200 is on top, 150 below, 50 below, downtrend. So the sequence of the moving averages gives you a very good clue. Yeah? Now, a common question people ask is, does it always go through stage 1, 2, 3, 4? The answer is no. It doesn't always go through stages in the sequence. In other words, a stage 2 doesn't always lead to a stage 3. You could have a stage 2 uptrend that straight away goes into a stage 4 downtrend without going through stage 3. All right? And sometimes you could have a stage 4 downtrend going into a stage 2 uptrend without going through a stage 1 broad consolidation. So they don't have to be in this sequence. They don't have to be, okay? Now, the whole point of understanding this is not to predict that, oh, now it's stage 2, it's going to stage 3. No. The whole point of this is to look at the chart and then to tell which stage is it in. Which stage is it in? All right? So, for example, let's take a look at the S&P 500 right now, which is the overall market. Where's my chart? Okay, there we are. So this is the S&P 500, and I've put in a lot more moving averages. So let me just hide the rest so it's not too confusing for you guys. Okay. And okay, so you tell me right now, what stage are we in? What stage does this look like? Is this stage 1, 2, 3, or 4? Yeah, this is still stage 2. Stage 2, right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. Okay? So it makes higher highs and higher lows. Okay? Are the moving averages all sloping up? Are they all sloping up? Yes. Is the 50 above the 150? Is the 150 above the 200? Yes. Okay? Could it be a topping phase? Could it be a topping phase, a stage 3? I don't think so. Not yet. Why? Because it is still 45 degrees. It is not yet 90 degrees. There's no 90 degrees. And you can see the price is actually near the moving average. Okay? It is come back near the moving average. So I don't think that we're in a topping phase yet. Okay? Now if we go back a few months ago, which was last year, can you see what phase was this? What phase was this? This was a stage 4, correct? This was a downtrend phase. Can you see? The 50 below the 150, 150 below the 200. Then from stage 4, it went straight into stage 2. It didn't go into stage 1. Correct? And then before this, what phase was this? This was another stage 2. So stage 2, 4, 2. So we didn't really have a topping phase here as well. Okay? So again, important question to ask is, where are we now? We are now in stage 2 for the S&P 500. Now, of course, individual stocks will all be in different phases. Okay? Will all be in different phases. Like, for example, let's look at Apple. How about Apple? What phase is Apple in now? Apple is now in stage 2, right? Stage 2. 50 above 150, 150 above 200. Now, some people may say, does it look a bit like a topping phase? Because this looks a bit 90 degrees. Maybe it could be. It could be. So sometimes you may not be 100% sure. Okay? Before this stage 2, okay, before the stage 2, what was this phase? What is this phase here? This stage 1. Stage 1. So can you see this was a stage 1, broad consolidation, can you see? And then stage 2. And now, I don't think it's a topping phase yet, but, some of you may think it looks like a bit topping, but I don't think so, all right? How about this? What phase is this? This one. Stage 2. Very good. You see, you guys are experts. So simple, right? Now you can read stages. Now you can read stages. How about Lululemon? What stage is this? What stage is this in? Oh, that's stage 4. Okay, so this is clearly a stage 4 downtrend stage. This was a stage what? What stage is this? What stage is this? Stage 2. This was 90 degrees. Can you see 90 degrees here? That was stage 3. Very good. So stage 2, stage 3, stage 4. You guys are good at this. You guys are experts already. You know? Okay, let's look at Nike. Now, this was some time ago. This is not a recent chart, but just to show you again, tell me what stage this is in. What stage? Stage 1. Very good. How do you know? Because moving averages are crisscrossing, right? That's right. And you can see it's kind of like in a range, right? In a range like that, like a box. Then here, stage 2, very good. 50 above 150, 150 above 200, all sloping up. And here, can you see 90 degrees here? Can you see going up 90 degrees here? Yeah, here's stage 3. And here, stage 4. Fantastic. Okay. So now that you understand the different stages, next thing is to know what strategy to use for which stage, right? So let's talk about stage one. When you see a stock in stage one and the moving averages are crisscrossing all over the shop and the price tends to make the same high, right? It makes a high and makes a same high and makes the same high and makes the same low, right? It's like in a range. It's like trading a range. What strategies do we use when you see a stock in a range like that? Okay. You either use a simple trade the range strategy or you use a slingshot mean reversion strategy. Okay. So these are all the different strategies that I teach in the stock trading course. And every strategy has got specific entry rules and specific exit rules. But I'm going to give you a few examples right now. Now, trading the range is actually a very simple strategy. In trading the range, basically, it's very simple. Notice I drew a line here. What line is this called, by the way? What line is this called? It's called support, right? Yeah. So support is where the price tends to drop to this level and reverse up. Drop, reverse up, drop, reverse up. Why does this happen? Why is it every time the price goes to this level, 48, it tends to reverse up? Why? Why does it do that? Is there a ghost there? Is there an invisible hand lifting up the price at $48? No, it's because at $48, a lot of buyers are queuing up to buy at 48. So the moment the price reaches 48, the buyers will buy, right? And because there's more demand than supply, the price reverses up, reverses up. We call that a demand zone, okay? And we call it a support level, okay? And then every time the price goes up to a certain level, let's say in this case about 57, what happens? The price goes down again. Goes up near the level, goes down again. Why? Because this is called a resistance level or a supply zone. Because at 57, a lot of sellers are queuing up to sell at that price. It's a psychological level. So once it reaches 57, sellers will rush in and sell, and supply exceeds demand, and the price reverses back down again. And of course, like what Alson taught yesterday, a lot of it is market maker manipulation as well. Okay, where market makers will manipulate and it creates all these patterns. Now, so once you draw the support and resistance level, then if you are simply trading the range, very simple. Where do you buy? Where do you buy? That's right. You buy when the price hits the support and you see a bullish candle bouncing off the support. So in this case, you can see the price going down, going down, going down. Once it hits this 48 there, and you see the first green candle, you buy that. That's your buy price. Okay? Because you know that in this range, there's a high probability that is going to go back to that resistance. Okay? But again, is it a guarantee? Is it a guarantee after you buy, it will shoot up? No guarantee. After you buy, could it go back down? Yeah, that's why you always put a what? Put a what here? Put a what? Put a stop loss. That's right. Put a stop loss. So you're buying here, stop loss there. What is this called? That's called your 1R. Okay? And your profit target, you could aim for 2R here. But for trading the range, we normally aim to take profit near the resistance. Right? Not right at slightly below, let's say 56. We take profit at 56 here. Then we could get up to a 3 to 4R profit, right? This could be up to a 3 to 4R profit. So you're risking 1R to make 3R. Is that a good deal? Risking $1 to make $3. Is that a good deal? Yeah. And even if you're right half the time, so half the time you're wrong, it goes down, you lose $1. Half the time you're right, it goes up, you make $2-3. And if you keep doing this, you will be profitable, right? Your wins will cover your losses. It is really pretty simple. Okay, it's not rocket science. So this is called trading the range, which is buy at support, sell at resistance. That's it. Okay. If you want to be more sophisticated, then you could use the slingshot mean reversion strategy, which has a bit more rules, where I use what we call oversold indicators. Like I use this thing called the Bollinger Bands and the stochastics to make sure stochastics, Bollinger Bands are way oversold, and I see a bullish candlestick pattern and I enter. Okay. And I'll give you some of the entry rules in a while. Yeah. Now, common question some of you may ask would be, how do I look for these? How do I look for stocks that are showing this stage 1 pattern? So there are a few ways. Let me show you a free way. You can go to finviz.com. It's a free website, okay? And go to look for this signal called channel signal. So channel shows you stocks that are in a broad consolidation channel. Yeah, so if you click on this, yeah, it'll show you all the different stocks that are in this stage 1. Okay. Now, some stocks, you notice that it has got this very strange pattern. Ignore all these, right? Ignore these are not normal stocks, right? Some of them are bonds, some weird shit. Okay, ignore it, right? And ignore stocks that have a lot of gaps. Like you see here, there's a lot of gaps. Yeah? Ignore the ones with all the gaps. Ignore it. Okay. We are looking for stocks that look more regular. And we're looking, if you're looking to buy, you're looking for the ones where the price is near the support. Can you see? Near the support. Now, let's look at KGS, for example. So for KGS, let me click on that. Okay. You can see it is in a stage 1. Would you agree? It's a stage 1? Okay. But has it dropped to the support yet? The support is at 26. Has it dropped to here? No. So you put this on your watch list. Watch it. Every day, watch it and see if it hits 26. The moment it hits 26, and you see that it hits 26 with a bullish candle, then you buy. And then put a stop loss below that. And put the profit target near the top. That's it. Very simple. No brainer. Trade the range strategy. Very easy. That's it. Okay. So this can be on a watch list, for example. Right. And every day you're looking for stocks that look like they could be setting up. Let's see if we can find some examples of stocks that are near the setup right now. Hold on. Let's see. No. 102. This one looks a bit weird. That's not a normal stock. This already broke above the resistance. So it's out of stage 1. This looks like it's going to stage 2. Hold on, I think I saw one earlier on. Yeah, this one. Okay, let's take a closer look at this chart. Let me use. Okay. There we are. Would you agree that this looks like it's a stage 1? Although the moving averages have not really crossed each other, but it's kind of like moving sideways, right? It's kind of like making same highs, right? And same low, same low, same low. So can you see that it's a bit of a range here? Can you see that? Can you see it's a bit of a range here? Okay. So right now, the price has dropped to the support level, which is about $19. Okay, let me zoom in a bit. Okay, so it's dropped here. And by the way, it also hit the 200 moving average, which is a pretty strong support, right? And it kind of like bounced up here. So now it's at $19.30. So could this be a potential trade? Could this be a potential trade? Yes, but it's not perfect. I tell you why it's not perfect, because this is a red candle. I don't like that. I like to always wait for a green candle, a bullish candle before I enter a long trade. So this red candle, I don't like it so much. Right? I don't like it so much. But if this was a green candle, I would look to enter the trade. So I could buy at, let's say, right? Let's say I could buy at, let's say, $19.36, for example. And I'll put a stop loss below, the recent swing low. Let's say roughly about here. Okay. So, oops, sorry. Okay. So I buy at $19.36. That's my buy level. Okay. I put a stop loss at $18.96. That's my stop loss. So what's my 1R? What's my risk per share? $0.40. Okay, so I'm risking 40 cents for every share I buy. How many shares do I buy? Later, I'll teach you how to calculate your size. Okay. So if I'm risking 40 cents, I want to make at least 80 cents. So do you think that if it bounces up, I could get at least 80 cents? Yeah, should be, right? Now, where do I take profit? Now, I could, of course, aim to take profit here. But if I'm a bit more conservative, I'll take profit somewhere here at the recent swing high or slightly below that. So let's say I take profit somewhere, roughly somewhere here below that. Let's say I take profit $20.30. Okay. So if I take profit here, how much money would I make? 2030 minus 1936. 2030 minus 1936 is 94 cents. Okay, I'll make 94 cents. And 94 cents would be how many R? 94 divided by 40, that's about 2.3 R. That's a decent trade. That's not a bad trade, risking $1 to make $2.30. Can you see that? Okay. So trading the range is pretty straightforward. It's a pretty simple strategy. But again, if you want to be more sophisticated, you can use what we call the slingshot mean reversion, which I teach in detail in the stock trading course, but I'll give you some of the entry rules today to give you an idea how I use it. Okay. And you can use the slingshot to enter a stage one as well, So let me open up my slingshot setup. Slingshot. There we are. Slingshot. Ta-da! Okay, there we are. That's my slingshot. So a slingshot is kind of like when the price drops to a certain level, I expect it to sling back up. It's a slingshot. Okay? So how do I know it's going to go back up? Again, there's no guarantees. It's a probability. Yeah? And I look for three things. Again, I'll show it to you. I'll show you the entry rules later, but I'm just giving you a kind of like a preview right now, okay? So the first thing I look at is I want to make sure that the price drops in a very sharp manner, okay? So the price drops and it makes what we call a double bottom. Okay, can you see this is called double bottom, right? So it makes a double bottom. That's the first thing I look at. It must make a double bottom. Number two, when the price drops, it must go outside the lower Bollinger Bands. You see this dotted line, that's called Bollinger Band. And notice whenever the price goes slightly out the Bollinger Bands, it will snap back, right? So you can see here, it went outside the lower Bollinger Bands. So it's oversold. And then you look at the stochastics, it must go below 20, oversold. So that tells you that the price is oversold, ready to snap back. So Bollinger Bands are penetrated below, stochastics are below 20, price makes a double bottom, and it must have a bullish candle, which unfortunately this has not yet happened. So I would not take this trade. But if I see a green candle, I'm going to enter with a slingshot, right? Because then I know I've got a high probability that it's going to slingshot back up. Again, it's not a guarantee, right? It will happen more than half the time, okay? That's my slingshot. Okay, is this useful so far? Does this make a bit of sense? Okay, so that's stage one. By the way, in stage one, we go long, that means we buy near the support, right? When it hits the support, we buy. But when it goes to the resistance, can we sell? Could we short sell here to catch it down? Yeah. So you long at support, short at resistance. Okay. But generally, if the overall market is in a bull market, like now, I generally prefer to go long at the support and not so much short at the resistance. Because in a bull market, there's a high chance it could break the resistance easily and start a stage 2 uptrend. Okay? Now, let's go to stage 2. Let's go to stage 2. So in stage 2, we call it the uptrend accumulation stage. Now in stage 2, do you ever want to go short? Do you ever want to short a stock on a stage 2? No, you don't, okay? Unless you want to commit financial suicide. So remember, stage 2, don't ever short a stock. Only go long a stock. Go long a stock, right? And again, how do you know it's stage 2? How do you know? Okay, so what I taught you earlier on is that the blue line, which is the 50 simple moving average, must be above the 150 green line and the 150 above the 200 red line. Remember? And all these three are simple moving averages. Okay, now I'm going to add 2 more moving averages for you today, which is this red thin line and the blue thin line. Okay, these 2 lines are exponential moving averages. So this is a 20 exponential moving average. We call it 20 EMA. And this is a 40 EMA. Okay. So for me, I would only buy if, write this down, on a stage 2 uptrend, I will only enter if the 20 is above the 40. Okay, the red line must be above the blue line, and the 50 must be above the 150, and the 150 above the 200. So this is called the uptrend sequence. And when you got the 20 above the 40, the 50 above the 150, 200, that means your uptrend is very strong. Your uptrend is very strong. And the probability of the price going up is pretty high. Okay? So I must see this sequence, 20, 40, 20 above 40, 50 above 150, 150 above 200. Okay? Now, then the next question is, when do I enter? When do I enter? Okay? Now, so there are 4 entry points based on the 4 different strategies. The first entry point is what we call the trend retracement entry point. Right? The trend retracement entry point. So trend retracement is when you see the price wave up, wave down, and hit a moving average. Okay? So once the price hits the moving average and you see a bullish candlestick, then you buy. Okay, same thing here. Wave up, wave down. Okay, bullish candlestick, that's a buy point. Wave up, wave down, bullish candlestick, buy. By the way, this candle, although it's red, it's a bullish candlestick pattern because it's known as a bullish pin bar with a small body and a long tail. So you see small body, long tail is a bullish pin bar even though it's red. And we'll teach this more in detail in the course itself, right? So red doesn't always mean bearish. Sometimes a red can be bullish if it's a small body and a long tail, okay? Here as well, right? Wave up, wave down, and bullish candle, that's a buy entry. So trend retracement is you buy when the price hits a moving average, bullish candle, you enter, okay? That's called a trend retracement entry. So that's a trend retracement entry. This is another trend retracement entry. Okay. Any questions on this? Now, again, I'll show you specific entry and exit routes later. I'm just giving you a broad idea. Okay. Another way to enter besides a trend retracement entry is to enter based on what we call a breakout from base entry. So a breakout from base is when you see the price, okay, on a stage 2 uptrend, the price goes up, makes a high, and then comes down, makes the same high, comes down, makes the same high, comes down. So this is a resistance. Can you see this dotted line is a resistance here? So it is a resistance within a stage 2 uptrend. I repeat, it is a resistance within a stage 2 uptrend. Okay, so whenever you see this, you can buy the moment it breaks out of the resistance. You see this bullish candle that closed above this resistance? This is a buy point. We call this a breakout from base entry. Because the price goes up, makes a base, this is called base, breakout, enter, catch the trend. Okay, breakout from base. Okay, so Duvel is asking, during a trend retracement, which moving average must it hit? It can hit any of the moving averages. It can hit the 50, it can hit the 100, which is this orange one, it can hit the 150, or it can hit the 200. It can hit any one of the moving averages, okay? But for me, I'll show you later on that not only do I want the price to hit one of the moving averages, but I must also see that the price hits a strong horizontal support level for me to be convinced that it's going to bounce. So hitting a moving average itself is not good enough. It must hit a moving average plus a strong support level. And I'll give you some examples later on, okay? So this is a breakout from base entry. Now, another way to enter a stage 2 uptrend, is called the breakout within base entry. And this is something I taught in detail in last year's webinar, if you watched my last year's webinar, okay? I won't go through in detail in this webinar because I want to show you other stuff, okay? So a breakout within base is when you see the price on an uptrend like that, this uptrend, and it goes into a base. It's called base. It goes into a base, and then it makes a temporary high. We call this a point A. And then it pulls back. Once it breaks the point A, we buy. And we catch the rest of the stage 2. This is called a breakout within base strategy. Okay? This is a base. So you enter within the base before the base is complete. This is the completion of the base. So we get in before the completion of the base. Okay? Finally is the flag breakout entry. So sometimes you see a stage 2. Again, this is a stage 2, right? You see a strong move like that, which is a very strong move. Usually this move must be more than 80% in less than 2 months. We call this a flagpole move. This is like a flagpole, right? It is like a flagpole, with a flag, right? Now, once you see this strong move, now this strong move could be caused by a catalyst like earnings, great earnings, or the company invented a cure for cancer, whatever it is, right? And let's say you notice this move, but of course you missed it. You didn't manage to catch it. Could you still get in? Yes. You wait for it to make a high and then a second high. You join the first high to the second high. We call this a flag, right? It's called a flag pattern. Once the price breaks this resistance, then you buy and you catch the rest of the stage 2 uptrend. Okay, so again, to summarize, in a stage 2 uptrend, there are 4 ways to buy: trend retracement, breakout from base, breakout within base, and flag breakout. Okay, each of these entry strategies have got a whole set of entry and exit rules. So these are all the things we cover in the stock trading course. Okay, let me do a quick summary by drawing. I love drawing because I think in drawing you may get a bit of a better idea. Okay. So let's say this is a moving average. Let's say this is the 50 moving average, okay? And when you see this pattern, wave up, wave down, wave up, wave down, okay? Price goes down and here you see a bullish candle. Can we buy? Can we buy? Yes. What entry signal is this? This is called what entry signal? Trend retracement. Very good. Okay. So when it hits the 50, how do I know it's going to bounce up? How do I know? How am I confident it's going to bounce up? How would I know? Ideally, I want to see that this 50 has been tested before once. So it hit the 50, it bounced off, it's coming back to retest it. So I want to see a previous test ideally. Now, but if I don't see a previous test, I need to see that this place here must be a previous support. Must be a support. This could be a previous resistance. So that I know that it's a very strong level here. Then I'm convinced to enter. Okay? Then where do I buy? I'll buy there. I'll put my stop loss somewhere here. Okay? So this is my 1R distance. Then I'll take profit somewhere here at 2R. Okay? So that is the trend retracement entry. Okay, next is you could see this pattern here. Hold on. So this pattern is the price goes up like that, wave up, wave down, wave up, wave down, wave up, wave down, wave up. And then this is a resistance. Okay, and then it hits this, comes down, goes up, comes down, goes up, comes down, goes up. Okay, and then, sorry, this should be a straight line. This should be a straight line. And then over here, it breaks this resistance. Okay, can we buy? Can we buy this? This, let's say this is the moving average here. This is the 50 here. Yes. What entry signal is this? What entry signal is this? This very good. This is called a breakout from base. You guys are good. Breakout from base. Okay. And where do I put a stop loss? I put a stop loss somewhere here. Again, that's my 1R. And I'll take profit at 2R. Okay. So that's my second way of entering a stage 2. Okay. Now, next, wave up, wave down, wave up, wave down, wave up, wave down. Okay. And then it goes like that. It goes down into a base. Price goes up, pulls back, makes a temporary resistance, consolidates here, and then we get a breakout here. Can I buy here? Yeah. Again, I buy here. I put a stop loss here. There's my 1R. And I take profit somewhere here. This is called a breakout within base. Okay. So someone is asking, 10 cut is asking, is this a cup with handle? It looks like a cup with handle, but it's not. Why? Because for a cup with handle, the price has to go to the all-time high here and then pull back and then break it. So this is a cup with handle. So we are entering way before the cup with handle formation. That's why it's called a breakout within base. All right. And the last one, which is not as common, is you see the price suddenly shoot up like that because of some catalyst news, and then it pulls back like that. What do we call this? This is called a flag breakout. That's right. And then when it breaks this flag, you buy there, stop loss there, you take profit somewhere there. Okay, this is called the flag breakout. Okay, so again, in the stock trading course, we will go through all these specific strategies. All right, so you know exactly what are all the entry rules, because some of them require you to look at volume, indicators, ATR, and many other things. But this is the general concept that I'm talking about, okay? Is this useful, everyone? What time frame should be used? Well, ideally, I would use it on at least the daily time frame, or the weekly time frame. The higher the time frame, the more reliable the patterns. If you use this on like a 5-minute, 30-minute, 1 hour, it's not as reliable, especially nowadays with a lot of algo manipulation. You don't get very, very reliable patterns nowadays because the algos will take you out. The market makers will take you out, okay? Okay, next will be the stage 3 topping phase. Now, so basically in the topping phase, you will see 90 degrees. Can you see? You see a 90-degree pattern. Now, the moment it goes up 90 degrees, do you start shorting it? Do you start shorting the stock? The answer is no, okay? No, why? Because sometimes it goes 90 degrees, it can still go up even more, right? Or sometimes it goes 90 degrees, it may pull back a bit and then shoot up again, and then you get killed. You get killed, okay? So just because it goes 90 degrees doesn't mean that you should short it. Doesn't mean you should short it, okay? So before I short it, I want to see a double top pattern. Okay, a double top is when the price goes up, makes a high, and then makes a higher high. Double top. Elson calls this a bear trap. Sorry, it's called bull trap. I get confused sometimes, but it's the same thing, right? It's a bull trap pattern, right? So again, this is a classic double top. And you wait for bearish candlestick pattern to short it down. And I like to use a slingshot mean reversion, which means I like to get confirmation from the Bollinger Bands and the stochastics. So I'll give you an example right now. But this is not really a topping phase stage 3. This is actually more of a stage 1 resistance, right? Which is Thermo Fisher, this stock. So look at this stock. This is more like a stage 1 resistance play, right? Now, can you see this double top pattern? Can you see this double top pattern? Yes. Is this going up 90 degrees? Yes. Okay. And did it go above the upper Bollinger Bands? Wait, let me kind of like zoom in. Did it go above the upper Bollinger Bands? Yes. So this is overbought. Look at the stochastics. Is the stochastics overbought? Is it above 80? Yes. So overbought. Do we have a bearish candle? A bearish candle formation. Now, right now the market is open and now the bearish candle is forming, right? But the market has not closed yet. So I wouldn't enter the trade yet. I would wait for today for the market to close, and only if it closes as a red candle, then the next day I could potentially short it. Only if it closes as a red candle. Right now, the candle is not closed yet, so it could still turn into a bullish candle. We don't know, right? We don't know yet, okay? Okay. And again, if I sell it here, I'll put my stop loss somewhere there. So that's my 1R, right? And then my profit target will be here at the support. So if it drops all the way down, I'll make about 2R. All right. So this is an example of a slingshot short setup. Okay. Where we enter on the double top, we see outside upper Bollinger Bands, stochastics overbought, and then we short it down. Okay. And again, for those of you who are new to trading, this may seem a bit overwhelming. So what's a Bollinger Band? What's a stochastics? What the hell are you talking about? So don't worry. In the trading course, we go step by step from the basics. But I'm assuming that some of you already have trading experience. You know what's a Bollinger Band. You know what's a stochastics. You know what is a bearish candle, bullish candle, right? Then, of course, you can follow me a lot easier. Yeah. Okay, finally, stage 4. Okay, so stage 4 is when you see a stock that's on a downtrend, and it's hard to find a stage 4 now because the market is in a bull market. So there are not many stocks on a stage 4. There are, okay, and of course you want to short it on a stage 4. So on a stage 4, do you ever want to buy a stock to take a long trade? You want to buy a stock to take a long trade? No, unless you want to lose. Okay, so on the stage 4, you don't want to buy unless you are investing. Investing is different. For investing, if I taking a long-term view, I may buy it for an investment. Okay, but for trading, short-term trading on a downtrend, you never want to buy. You want to stay away or you want to short it. Okay, but you want to short it during a rally to the resistance, then you short it, catch the wave down, wave up, hit the resistance, short it, wave down. Yeah. Okay, great. So let me give you some specific rules for some of the strategies that I've introduced. The first is the trend retracement strategy. Okay, the first is the trend retracement strategy. So here are the entry rules. Number 1, I want to first make sure that the stock is on a confirmed uptrend. Okay, so this example is Alta. And can you tell me, is it on a confirmed uptrend based on what you see here? Do you see a confirmed uptrend? Yes. How do you know? Because the 20 is above the 40, the 50 is above the 150, 150 above the 200. Moving averages are all in sequence. So that's how you know it passes the first entry rule. It must be in an uptrend sequence. Okay. Number 2, the price must retrace to a moving average and a support level. Okay. So you can see wave up, wave down, wave up, wave down. So it has retraced to a support level. Okay, so how do I know that this is a support level? First, it is hitting this orange line, which is the 100 moving average. And previously, you can see this 100 moving average has been tested before. Okay, it has been previously tested. So I know that this orange line could potentially be a support level. Plus, can you see this was a previous resistance? Resistance, once broken, becomes support. So this line here that I drew is a horizontal support. Okay, so I've got the price hitting a moving average and a horizontal support. That gives me confidence that this support will hold. Next rule is I want to make sure that the Williams R is oversold. Okay, now you can use Williams R, you can use RSI, you can use stochastics. It's the same thing. It's the same thing. They are all known as oscillators. Okay, you can use either one. It's up to you. Okay, so in this case, I'm using the Williams R, and the Williams R must go below minus 80. Can you see? So during the drop, it went below minus 80. That means it is oversold. When a stock is oversold, that means it has a good likelihood to snap back. Next rule, I want to wait for a bullish candlestick pattern. Okay, so I will not enter after this red candle. I need to wait for a bullish candle to confirm the reversal. So this bullish candle is my confirmation candle. Can you see? That is my confirmation candle. So once I have all these rules that are met, right? Met. All these rules are met. Then I will buy. I will enter the trade roughly 3 cents to 10 cents above the candle pattern. So I could place a buy order just above this candle pattern. So in this case, it's 373.80. So that is where I place the buy order. Okay. So CL is asking, how about MACD? Now, if you actually take my trading course, I look at 3 indicators. I look at MACD, I look at Williams R, and I look at Force Index. And I just need one of them to confirm. So in this case, because I've got the Williams R that confirms the oversold level, I don't need MACD or Force Index to reconfirm it. Okay? I just need one indicator to confirm it. That's it. Yeah. Now, in every trade, you must have the exit rules. So again, when I buy, will it always go up? Will it always go up? No, no such thing. Could I buy and it drops down? Of course. So I need to have exit rules. So what's my exit rule? My exit rule is I will cut loss 3 to 10 cents below the swing low. What is the swing low? Swing low is this lowest point. Okay, is the lowest point. So below this lowest point, at about 3 cents to 10 cents, I will place my stop loss, which in this case is 354.8. Or I will place my stop loss 1.5 ATR below the entry price, whichever is lower. Now, some of you may not know what is ATR. ATR means average true range. Average true range is the average range of the candles. So you need to find the 14-day ATR and then multiply by 1.5 to get the 1.5 ATR distance. So my stop loss must be below the swing low or 1.5 ATR below the entry price, whichever is lower. Now again, if you're not sure what is ATR, again, we'll cover this in detail in the course itself. But for now, I don't really have the time to go into that because ATR itself will take a bit of time. Okay, I'll tell you what, let me teach you anyway. Can I spend a bit of time teaching you? If I overrun, is that okay? Because some of you are asking me. Yeah, okay. All right, fine. Let me teach you what's ATR, right? So, let me just explain a bit about what ATR is. Okay. Okay. Now, when you look at these candles, hold on, let me take out my drawing tool. Okay. Now, when you look at a stock, notice that we're looking at the candles, right? The candles. Every day you've got a different candle. Okay. Now, the top of the candle to the bottom of the candle, this is called the range of the candle. The range, right? So let's say on this day, this top to the bottom, the range is $5, okay? Then on the previous day, the top to the bottom, the range is, let's say, $6. Then here, the range is $5. Here, the range is $7, okay? So the range of the candle tells you on a particular day how much the price will move. You understand? So for this stock, if the range is $5, it means that this stock moves $5 a day on average. Okay? Now, if I take the average of the last 14 days, which is the norm, okay, I get what we call the average range of the ATR. Okay? So in this case, if I take the average of the last 14 days, let's say the ATR is $5. So what does this mean? This means that this stock moves about $5 every day. Okay? Is this important? Yes, because this will tell you where to put the stop loss. When you buy a stock, let's say you buy a stock here, will it always go up in a straight line? No, because after you buy a stock, it could go up like that, like that, like that, right? It could do this, correct? How many of you have experienced that after you buy a stock here, let's say you put a stop loss here. After you bought a stock, it dropped, it hit your stop loss, and you sold it, and after you sold it, the bastard went up. Has that happened to you before? Yes. So why does that happen sometimes? Because your stop loss is too close. Your stop loss is within the range of the price movement, okay? So if you know that this stock has an ATR of $5, that means the stock moves $5 a day, then your stop loss has to be what? Your stop loss has to be what? Has to be more than $5 away, correct? Yeah, so you get the point? So once you know the ATR of a stock, you must multiply it by 1.5. So 5 times 1.5 is, sorry, I'm not good at mental maths, 7.5, okay. So for this stock, I must put my stop loss at least $7.50 away from my buy price, okay? So always make sure your stop loss is at least 1.5 ATR away from your entry price. So it will not be hit easily by the daily volatility. Now, how do you find the ATR? How do you find the ATR? The ATR is on any trading software. So for example, on this trading software, I'm using TradingView, look for average true range. Can you see that? You click on that, you get the ATR here. So let's say this stock, MPWR. By the way, can you see, is it showing a trend retracement setup? Can this be considered a trend retracement setup? Yes. Why? Look at that. Wave up, wave down. Can you see it hits the 50 moving average? And it is also a support level because this is a previous resistance, breakout, hit. So this is a trend retracement setup. Okay? So in fact, I could actually put a buy order here. Now it's a bit too late. The price really went up today. Damn it. Never mind. I'll find another one. Okay. Hold on. Let me use this dotted line here. Okay. So let's say this is my buy order. Okay. Now, where do I put my stop loss? Where do I put my stop loss? If I'm buying here, I put my stop loss just below this swing low, right? Can you see? So I put it somewhere there. Let's say I put my stop loss at 760.77. What is this called? What is this called? My 1 hour. So in this case, what is my 1 hour distance? It is 829.7 minus 760.77. What's that? 829.7 minus 760.77.
Hello. Hello.
Sorry, give me a second. Oh, sorry, my sound went off. Sorry. So what is 829.7 minus 760.77? It's about $69 roughly, right? So this is $69. Okay. Now, is this at least 1.5 ATR? Is it at least 1.5 ATR? Well, let's check. Okay. So what is the ATR? Can you see the ATR here? So right now the ATR, I put my mouse here. My ATR is 36.49. Right? So what is 1.5 ATR? $36.49 times 1.5 is 54.73. Okay. So in this case, if I put my stop loss here, which is $69, is it more than 54? Is it more than 54? Yes. So it's okay. Remember I told you whichever is further. All right. So in this case, this is the further one. I'll take this one. Okay. Is that clear? Okay, cool. So that's the ATR. Okay. So let's go back to this example again. So in this example, I put my stop loss below the swing low. And of course, I make sure it's at least 1.5 ATR. In this case, what is my 1 hour distance? My 1 hour distance will be 373.8 minus 354.8. So that's $19. So every share I buy, I'm risking $19. Okay. Then where do I put my profit target? If I'm risking $19, I'm risking 1 hour. let's say I want to make at least 2R. So $38 is my profit distance. 38 plus 373.8, my take profit will be 411.8. Got it? So that is how we enter a trade with the 3 orders placed. By the way, this was a trade which I shared with my students. As you can see, this was here. I just spotted Alta for trend retracement setup, finding support at the 100 moving average with additional horizontal support. Williams are oversold at the recent swing low, plus a bullish engulfing candlestick pattern. As always, a valid high probability trade does not mean it will always be a winning trade. So please place the stop loss. So this was shared in my community. And you can see I entered the trade on this day. Okay, it was triggered on this day. And initially the price went down, as you can see, but eventually the price went up and hit the profit target. Okay. And this is one of my students, Angelica. Thanks, Adam, for this tip. Made 1,000 on Alta. Right. Now, of course, not every trade is a winning trade. We have losing trades as well. We have winning trades as well. All right. Okay. Is that cool? Are you now clearer? Okay. Michael is asking, do you move your stop loss as price increases? Yes. Good question. I do. Okay. So what I do is I buy here. I put a stop loss here. This is my 1 hour distance. Okay. Once the price moves up by 1 hour, I will shift my stop loss to my entry price. Once I shift my stop loss to my entry price, what happens? I've got a risk-free trade. Because the worst that can happen is if the price drops back down again and hits my stop loss, I will exit at the entry price. Got it? Yeah. So that's what I do. Yeah. I will shift the stop loss to the entry price once the price moves up 1 hour in my favor, so that I take risk off the table. Okay. Some people ask, is there a risk of gapping down? Yes, there's always a risk of gapping down. And that's why in trading, never trade during the earnings results. Okay. Always make sure that you enter a trade when there's no earnings results that are coming up. And if you are in a trade before the earnings are released, always get out before earnings are released. Because when the earnings are released, it could either gap down or gap up. It's a 50-50. You don't want the risk of it gapping down. Okay? Okay, the other strategy which I talked about earlier on is the slingshot mean reversion strategy. And I gave you an idea of how it works, right? So the slingshot, you don't have to use it on a stage 2 uptrend. You don't need it to be an uptrend. You can use it in a stage 1. Okay, so stage 1, remember, is a consolidation where the moving averages are crisscrossing. Can you see that? Okay, so when it's crisscrossing, you can use a slingshot. So in this case, what are the entry rules of a slingshot? Number one rule, the price must drop rapidly, parabolic, which means 90-degree drop. So over here, do we have a 90-degree drop? Yes? Yes. Okay, so that's rule number 1. You must see a 90-degree drop. Okay, number 2, the price must pierce the lower Bollinger Bands. Okay, so over here, can you see that the price, does it pierce the lower Bollinger Band? Yes. Third rule is the stochastics oversold. This is my stochastics. It must be oversold below 20. Okay. Next, I want to see a double bottom shakeout pattern. So this is called a double bottom. And I must see a bullish candlestick pattern to appear before I can enter. I need a bullish candlestick confirmation candle. So once it has met all my entry rules, met, I then place a buy order just above the candle, the confirmation candle, right? So in this case, I put the buy order at 2441. Okay, I put a buy order at 2441. And again, after I buy, is it a guarantee it's gonna snap up? No guarantees in trading. So you're gonna put a stop loss. Where do we put a stop loss? Stop loss again, a few cents below the swing low. Okay, that's my swing low. My stop loss is there. What's my 1 hour distance? 2441 minus 2375. My stop loss is 66 bucks. Or rather, my 1 hour distance is $66. Okay, this is also my risk per share. Every share I buy, I'm risking $66. My profit target, I target 2R, will be 2573. Okay. So in this case, you can see this trade, the next day the price went up, came down, went up, hit the profit target in 1, 2, 3, 4, 5, 6, 7 days. 7 days, I'm out of the trade. Okay. So this is used for a stage 1. The previous example was used in a stage 2. So you got to know which stage. And depending on the stage, you use the appropriate strategy. Okay. And again, if you learn options, can you use options to execute the trade? Yes. So instead of buying a stock, you can use all kinds of option strategies that can massively increase your win rate to 70 to 90%. Okay. So for me personally, once I find these trades, I may choose to enter with a stop or enter using options, depending which gives me a better bang for the buck. Yeah. Do I wait for the confirmation, then the next day you place the order, Joshua? Yes, I wait for the confirmation candle to close and then I enter the next day. Okay, I don't enter on the day where the confirmation candle has not yet closed. Okay. So what makes a profitable trader? There are 3 things to be a profitable trader. Okay. The first thing is you need to have a trading strategy, or you need to have a set of trading strategies that give you a statistical edge in the market, that give you a high probability. So let me ask you this. Do you think that most traders, most retail traders have specific strategies where they write down the strategy with specific entry rules and exit rules? Yes or no? I can tell you no. I can tell you that most traders out there, they have no specific strategy. They buy and sell based on emotions, on news, on rumors, on listening to opinions, and listening to predictions. If you do that, you are nothing more than a gambler, and eventually you're going to lose all your money. Okay. So if you trade with a specific trading plan, with specific trading strategies that have a statistical advantage in the market, you are way ahead of most people. Right? So today I've shown you some strategies, right? The trend retracement, the slingshot, and of course there are many more that are used at different stages in the market. Yeah. So of course in a stock trading course, you will learn all these trading strategies. But is that good enough? No. So you can see that it's very important to have a good trading strategy. But even if you have the best trading strategy, you will not make money. You will not make money unless you have the second key, which is proper position sizing. Proper position sizing. Position sizing is also known as money management. Okay? So position sizing tells you how many shares to buy or how many shares to sell. Okay? And it tells you how much to risk. Let me ask you this question. Even if you learn the best strategy from the best trader in the world, could you still lose money? Even if you learn the best strategy from the best trader in the world, could you still lose money? Yes, you could still lose money if you do not size your position correctly. Why? Even if you learn a strategy with a 90% win rate, could you go broke? Even if you learn a strategy with a 90% win rate, could you go broke? Yes. Why? Because what does a 90% win rate mean? What does it mean? It means that in 100 trades, statistically, you will have 90 winning trades and 10 losing trades. Agree? But the problem is you don't know when the 10 losing trades will appear. You never know when it's going to appear. Is it possible that these 10 losing trades could come in a row where you got loss, 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 loss? Is it possible? Yeah, in fact, sometimes you find that in life, when it rains, it pours. When you get one bad luck, all the bad luck come together, right? Okay. And imagine that if you trade and you risk too much, and let's say you risk 30% of your capital in a trade, and it so happens that you get 4 losing trades in a row, what happens? Your whole account get wiped out. And when the winning trades appear, you're no longer in the game because you got blown out. You understand? So you have to keep your risk very small, so that in the event when you get the losing streak, you are still in the game. Your capital is still there to capture the winning streak. You follow what I'm saying? Okay, so let me teach you some very important position sizing rules. Please write this down. This is critical, very, very important. Number 1, always risk a fixed percentage of your capital for every trade that you take. My suggestion is 1%. So please don't do this. Don't say, oh, this trade I risk 1%, this trade I risk 3%, this trade I risk 2%. No, if you do that, you will mess up the statistics. You got to be consistent. If you're risking 1%, 1% of every trade. If you risk 2%, it's 2% in every trade. You can't keep changing it. Okay? So for this example, we stick with 1%. That's right, 1% of your net liquidation value, which is the capital that you have. Yeah? So write down this formula. Write down this formula. Okay, thank you, Annie. I really appreciate that comment. Yeah. So the number of shares to buy is equal to your percentage risk per trade multiplied by your net liquidation value. Okay, so in this example, what is the percentage risk again? Very good, 1%. What is net liquidation value mean? Net liquidation value means your capital, which is how much cash you have in your account plus the value of your existing shares. That's called your net liquidation value. So let's say right now in your account, you have $10,000 of net liquidation value, okay? So what's 1% times 10,000? The answer is $100. Agree? So listen very carefully. Listen very carefully. Write this down. If you have a $10,000 account, the maximum risk you can take is $100 per trade. If you have a $10,000 account, every trade you take, the most you can afford to risk is $100. Okay? So this $100 is your total risk. You have to take the $100 total risk divided by the risk per share. What is risk per share? It is your 1 hour distance. This will give you the number of shares to buy. So let me give you an example so that it's crystal clear. So let's go back to that earlier example on Alter. Okay. So let's say you have defined your entry price is 373.8. Your stop loss is 354.8. And your profit target is 411.8. Okay. And your 1R is $19. So you have put in all these prices. Okay. So let's calculate your position size. So assume that your capital is $10,000 and you're risking 2%. Now, again, it could be 1%, but in this example, let's say it's 2%. Okay. So what is the maximum loss per trade? 2% times 10 grand is $200. Okay, cool. So putting in the formula, okay, the number of shares that you can buy is $10,000 times 2%. So that's $200. $200 is your total risk. Is your total risk. So you take your total risk, divide by your risk per share, which is $19, which is the 1 hour. Okay, this is your 1 hour. This gives you 10.5 shares. Ta-da! That's it. That's how many shares that you buy. Got it? Okay. Now, what is your position size? What is your position size? Okay. Now, let's round it down to 10 shares. Okay. Let's round it down to 10 shares. So each share you're buying at 373.8, right? So 373.8 times 10 shares, you are buying 3738 worth of shares. So out of 10 grand, you are buying 3738. This is called your position size. It's called your position size. Now, question, is your position size your risk? Is your position size your risk? No. What is your risk? What is your risk? Your risk is $200. Understand? So remember this, write this down. Your position is not your risk. Your position size is not your risk. Your risk is $200. Why 200? Because it is 2% of your 10 grand capital. Okay? Now, if you enter the trade and the price drops to your stop loss, what happens? You will lose $19. Agree? You will lose $19 times 10 shares, which is $190 that you lose. And $190 out of 10 grand is 1.9% loss, which is roughly 2%. Okay? If it hits your profit target, you make $38 per share times 10, you make $380, which is roughly about 3.8% gain. Do you follow me? Okay, so now are you clearer about how to size your position? Okay, great. Now, when you enroll in a stock trading course, you don't have to do this manually because you can download my position sizing calculator, okay, which is here. So once you enroll today, if you want to learn how to trade properly, take the course, you can download this calculator. So with this calculator, straight away, you put in 10,000, you put in 2% risk, you put in 373.8, you put in the stop loss, which is 354.8, okay, and you target a risk to return of 2. You can see straight away it tells you number of shares to buy, 10.53. Ta-da! Right? So this calculator is very useful. before you enter a trade, use this calculator. Immediately, it tells you how many shares to buy. And if it's a fraction, you can always round it down to 10 shares, right? Round it down, okay? There we are. So the key to trading is to treat trading like a business. Now, if you are running a business, you need a business plan. Similarly, in trading, you need a trading plan. So in trading, what's our plan? Our plan is to always enter with an entry price, a stop loss, and a profit target, right? And we always want to make sure that we are risking 1 to 2% of our capital. And when we get a winning trade, we want to make 2 to 4% of our capital, right? So risk 1 to make 2, risk 2 to make 4, okay? And we know that if we follow the high probability setup, where we only enter a long trade on a stage 2 uptrend, we get in at the strong support. We wait for bullish candlestick pattern. We wait for the stochastics to be oversold, or we wait for the slingshot setup. Bollinger Bands are hitting the lower Bollinger Bands, hitting the stochastics oversold, waiting for bullish candlestick pattern. So when we wait for these setups, you know that there's a high chance the price will go up, but there's no guarantee. You can't be right all the time. And we just need to be right 50 to 60% of the time. But in reality, there'll be 40 to 50% of the time, it will not work out, which is okay, all right? Why? Because like I showed you earlier on, okay, if you take 120 trades a year, remember at a 50% win rate, I showed you this earlier, okay? Each time you lose, if you lose 1% of your money, each time you win 2% of your money, that is a pretty good return. Now, what if you only have a 40% win rate? Even if you're right only 40% of the time, but you follow the rules strictly, you follow the trading plan, right? You get 48 wins and 72 losses. Each time you lose your 1%. Each time you win your 2%. Net, you're still making about 24% return. Is that better than fixed deposit? Is that better than fixed deposit? Yes. Is it better than most people who are gambling? Okay. So let me ask you this. If it's so simple, why doesn't everyone do this? If it's so simple, then why doesn't everyone do this and make money in trading? Why not? I can tell you the reason. It's because trading is simple. It is simple, but it is not easy. It is not easy. Why is it not easy? It is not easy emotionally. It is not easy psychologically to take those losses. A lot of people, when they take a loss, they get angry, they get frustrated, they get depressed, right? And it screws up their ability to execute their trades. Same thing, when they get winning trade, they get so excited, they get too overconfident, and they break the rules. So whether is it fear or greed, the emotions screw people up. That's why a big part of trading is what? A big part of trading is the psychology. It's the psychology, okay? That's why in the trading course, I spent a lot of time on the trading psychology because yes, the strategy is simple. The system is simple, but do you have the discipline to follow the system without deviation? Without changing the stop loss, without changing the profit target? Can you follow the trading system consistently? It is very difficult for most people who are not trained properly because of all their emotions of greed and fear. When you enroll in a trading course today, you will also get my trading simulator. Not stimulator, simulator, okay? So what is the trading simulator? Let me show you what it looks like. There, this is the trading simulator. You'll be getting this today once you enroll. And this trading simulator will simulate 100 trades. So if you take 10 trades a month, then in a year, it's more than 100 trades. In fact, we tend to trade more than 10 a month, right? So, okay. So you can see that if you have a win rate of 50%, okay, and each time you lose 1 R. Sometimes you may lose 1.1 R. And when you win 2 R. But you don't always win 2 R. Sometimes you win 1.5 R, right? So you put in all these variables, and let's say you risk 1% of your money, okay? And you start with $10,000, or you could start with $20,000, whatever it is, right? You put in the variables, okay? Now, if you start with 10 grand, okay, for example, you can see that even at a 55% win rate, you get a 63% compounded return. That's pretty good, right? Now, it's a random number generator. So sometimes you may get a lower number. Let me get a lower number, okay? Yeah. So at a 53% win rate, your 10 grand goes to 15 grand. That's a 56% return in a year. How many of you don't mind getting a 56% return in a year, even at a 53% win rate? How many of you don't mind? Okay, pretty good deal, right? But how many of you agree in life that there's no free lunch? There's no free lunch in this world. If it was so simple, everyone would do it, right? So why is this not simple? Sorry, it is simple, but it's not easy psychologically, because take a look at the simulator. Take a look at the simulation of the 100 trades. Look at it. Look at it. Take a look. Take a look. Look at the 100 trades. What do you notice? What do you notice? At a 50% win rate, do you always get win, lose, win, lose, win, lose, win, lose? No. You get sometimes what? You get sometimes what? Losing streak, winning streak, right? Look at that. You get losing streak. You get losing streak. You get winning streak. And a lot of people, if they're not trained psychologically, when they get lost, what happened? They get emotionally affected. Right? And then they deviate from the plan, they stop following the rules, and they mess up the whole system. That's why I say a big part of it is psychology. If you can have the discipline to follow the system through the wins and losses, at the end of the day, you will make money. Okay? So this is true whether it's stock trading, forex trading, crypto trading, options trading, futures trading. It's all the same thing. Okay? So all these tools are there to help you. Like my students, you see what they're saying, right? This is Kenny, and he said, hi Adam, good day. It's been 9 months of live trading. I've officially doubled my initial capital, even though my hit rate is only 50%, which is his win rate. I'm very glad that I attended your program last year. It was one of the few absolutely right decisions I made. This equipped me with a recession-proof skill set. Right? This Errol, he said, Adam, I'd like to thank you to let you know that your system works not only for swing trading, but also intraday trading. My hit rate for Hang Seng is less than 50%, but I managed to triple my capital by using your system, right? So you can see his stats, very interesting. He took 102 trades. He had 45 wins, 57 losses. His win rate is only 44%. But his average win is 2,000. His average loss is 1,000. So net, he made 25 grand out of 10 grand. So I keep saying it's not that you can predict the future. It's not that you can win every time. It's controlling your risk to reward. Okay. This is Eric, one of my favorite students. He's from Malaysia. He attended the course, my God, I think more than 10 years ago, right? And till today, he's trading every day. You can follow him on Facebook as well. He posts a lot of his trades. He said, God willing, I'm outperforming the S&P 500 with a 97% return against the wall of worries on the street, right? So I think now he's full-time trading, okay? This Sahok, thank you, Adam, Bang, and Awesome, the whole team for your guidance. One of my portfolios, 123% year on year. I'm planning to retire completely from my job soon, right? Okay, so time is a bit short, so I'm going to move a bit faster. Okay, so let me introduce you to the stock trading course that you can enroll for today. And it's an unlimited access. So it's all recorded videos, watch anytime, anywhere, at your own pace, okay? So we have got level 1 and level 2. Level 1 is called the Profit Snapper course, total of 15 hours of training. So this takes you from beginner to confident swing trader. Level 2 is the Market Snapper course, which is 16 hours plus, that lets you scale your profits in any market condition by mastering trend and counter trend strategies. Okay, so again, this course works for beginners and experienced traders. Noel is asking, does the position sizing calculator take into account the slippage and broker's fee? No, it doesn't. It doesn't, right? So yeah, there will be some brokerage fees. But again, if you use brokers like Interactive Brokers and even Robinhood or whatever, the brokerage fees is negligible. It's like $1 or $2 per trade. It's negligible, okay? So for the stock trading course, level 1, Profit Snapper course, these are all the lessons that you will go through. Lesson 1, what makes a successful trader? Learning about what makes trading the perfect business, what makes a successful trader, and the different trading systems and approaches. Okay. Lesson 2, the secret of consistent trading profits, understanding the statistics of how to trade like the house. Okay, most people, they trade like a gambler. Once in a while, they make a lot of money because of luck. Long run, they lose everything because they're trading with the odds against them. But who always wins in the end? The casino. The house always wins in the end because of the house edge. So when you learn to trade with a house edge by ensuring your risk to reward ratio is in your favor, by taking high probability trades, you know that over time, you will win, okay? Then lesson 3, you will learn how to master technical analysis. You will learn all about how to read charts, uptrends, downtrends, consolidation patterns, the 4 stages of the stock price. You learn in depth about moving averages, support and resistance, and so on and so forth, okay? Number 4, lesson 4 will be technical analysis part 2. Again, how to identify trends and mastering moving averages, okay? Lesson 5 will go a lot deeper into position sizing. So today I've given you the basic concept, but in this lesson, we go very much in detail into position sizing, okay? And money management. And how to automate your trading business with order management. So you don't have to be there when the market is open. How to automate your trading orders and how to place orders with the broker, okay? By the way, I've already taken out this CFDs because right now with high interest rates, it doesn't make sense to trade with CFDs. So I no longer do that. So I think I've taken that part out, yeah? So nowadays, I would prefer to use options, okay? Then we learn the specific strategies. So in lesson 1, you will learn trend retracement strategy. Excuse me. And lesson 7 will be the psychology of winning traders. Like I said, psychology is a very important part of the whole lesson. Lesson 8, how to develop a trading plan. Lesson 9, charting and brokerage platform. How to use the different charting software including a trading view and think or swim. And then lesson 10, the trade the range strategy, which I did talk about today, okay? Next will be the level 2 course. Level 2, Market Snapper, you learn the other strategies like the breakout within base, the breakout from base strategy, the explosive breakout, which is the flag pattern, momentum value rotation swings system, the slingshot mean reversion, which I showed you today as well, how to anticipate trend reversals with divergence patterns, Bollinger mean reversion. Now, this strategy was actually the precursor to the slingshot mean reversion. So this is actually an old strategy that I don't use anymore because the slingshot actually replaces this strategy. But I still leave it in there if you want to take a look at it, right? Capitulation is also an old system that's replaced by the slingshot system. So you can see that over the years, I've introduced more powerful strategies, but the old strategies are still there if you want to take a look at it, right? Learning about the power of confluence, and lesson 10 will be on day trading, which I personally do not do anymore. I don't day trade anymore because it's too time consuming, but the lessons are still there if you want to take a look at it. Yeah, but my focus nowadays is more on swing trading, which I will swing trade stocks as well as executing using options as well. Okay. So again, I've got all kinds of students. I've got beginners. I've got very experienced traders. I've got a lot of ladies, a lot of guys, right? So this is Liz. Hi, Adam. I know I'm supposed to be emotionless when I do trades, but I'm ecstatic as my first trade I've done after attending your course. I made over 30 grand. My God, she must have a very big account, right? Paid my course fee, right? I can see where my stocks are heading and not relying on my relationship managers. And one of the students I'm the most proud of is actually YY. And today, YY himself is a very accomplished trader and options trader. He's also our resident trading coach. But this was when he first started many years ago. And when he first learned and took this course, his first 1.5 years, he had 169% gain in his portfolio. Right? Yeah. And since then, he has gone on to make a lot more money, right? And this is one of my students from Vietnam. You know, I won't go through this because, you know, time, I'm running out of time because I want to leave some for the Q&A. Okay. So there are a few bonuses when you enroll in a stock trading course. Number one bonus, you get my trademark trading tools that you can download right away, including the position sizing calculator, the trading journal, and the trade simulator, which I showed you earlier on. Number two, you will get a free lifetime access to our trade discussion group on Discord channel, where you can ask questions any day, right? So 7 days a week, we are there chatting with our students. We're there sharing trades with each other. Ask questions anytime, share your trades, and get feedback. Yeah. Okay, so the trading course level 1 is 10 lessons over 15 hours that usually retails at $1,588 US. Stock trading course level 2, Market Snapper, 10 lessons as well, 16 hours of lessons. That's $4,088. Plus you get the trademark tools and the lifetime access to our stock traders discussion group. So the total value of this entire package is $7,376, but we put it into a package price that people pay for throughout the year of $5,676 US. Now, right now, Beat the Market, we have a crazy 60 to 70% discount of all courses. So you can grab everything, level 1, level 2, plus all the bonuses for only $1,702.8 US, $1,702.80. If you want to grab this crazy discount for now, scan the QR code or click on the link and you can get started. right? You can download the trading tools today. You can start watching the videos today and get started trading. If you got questions on enrollment, on payment, my team will be there to help you guys out. Yep, if some of you want to take level 1 first, of course you can do that as well. Yeah, you can let my team know if you just want to do level 1. That's fine as well. Yeah, but of course the best deal is you take the whole package for this crazy 70% off. Yeah. Okay, so fast action bonus. The first 15 minutes, those of you who enroll for the first 15 minutes, you get an additional stock trading live jumpstart workshop, which is a 3-hour online session with our resident trading coach, YY, the guy I talked about, who is one of our top students, and that was years ago. Now he's one of our fellow trainers and coaches. Get step-by-step guidance on setting up your trading account with your broker and how to set up your charting platform, how to enter your first trade, and you get unlimited replay access to this jumpstart workshop itself. So again, for the first 50 minutes, you will get this additional live jumpstart workshop. So once again, it's 1702.8 for this limited time offer. Scan the QR code, click on the link, and there you are. You can start learning about this, right? Now, let me share with you one more thing as you guys are enrolling. Like I said, for me, why trading has been really great for me and for Alson and for Bang is we treat trading as a business, right? How many of you have always wanted to be an entrepreneur, have always wanted to run your own business? If you have not already done so, right? Now, let me ask you something. In any business, you always have what we call sales revenue, right? And you have to minus your cost of goods, and that gives you your gross profit minus your operating expenses, and that gives you your net profit. Agree? So whatever business you're in, this is your income statement. Okay. So if you, for example, have a boutique, you're selling clothes, and each time you sell a dress, let's say your revenue is 200, the cost of making it is 100, your gross profit is $100. What's your profit margin? Your profit margin is 50%, right? Now, is this an okay business? Is this an okay business? Yes, okay. Correct. Now, the same thing with trading. Now, remember, in trading, when you have a winning trade, you win 2R. All right? So think of this as your revenue. But remember, you will have losing trades. So a lot of people, when they have a losing trade, they feel bad. Like, oh, I did something wrong. I made a mistake. I have a losing trade. No, you can follow all the rules and still have a losing trade. It's the rule, is the nature of the game, right? But when you have a losing trade, don't feel bad about it because it is part of the game. And when I have a losing trade, I treat it as my what? I treat my losing trade, when I lose 1R, I treat it as my cost of my revenue. Do you follow what I'm saying? Right? So if you have a 50% win rate, for every winning trade, you have a losing trade, you are still making a gross profit of 50%. So when you think of it that way, you don't feel bad about it. Okay? Because you can't say that I only want revenue, I don't want the cost. There's no such thing. No business is like that. Same thing in trading, you can't say I only want to win, I don't want to lose. No, right? So if you treat losing trades as a cost of business, then it's like any other business. Okay. However, why is trading the perfect business to me? Because number one, unlike most businesses where you have to work 16, 18 hours a day, especially in a new business, trading, you only need at the most 1 to 2 hours a day. That's it. 1 to 2 hours a day at the very most. So it's very flexible. Number two, you can work from anywhere in the world. You don't need any employees. You don't need to pay any rental. There's no competition, as in all the things I teach you about trading, you make a lot of money, I don't make less money. Because the market is so big, we can all make money together. It's not like I'm selling chicken rice and I don't teach you my recipe because you set up a shop next to me and you take away my customers. But trading is different. Trading, the market is so big, I can teach all of you and we can all make money together, right? Next, trading is a recession-proof business because if the market is going up, we can go long. It's in a bear market, in a recession, we can go short. We can trade whatever we want, right? And trading requires relatively low startup capital. Why? Nowadays, if you start a business, especially in Singapore, you need at least $500,000 for inventory, for the rental, for your employees, right? But in trading, you can start with as little as $1,000 or even $500 or 3K, 5K, whatever it is, right? You can start with relatively low capital. And trading is relatively low risk. Why? If you start a business like a restaurant or boutique and if it fails, you lose everything. You lose your $500,000, you lose your 300,000, right? But in trading, each time you trade, you only risk what? You only risk what? You only risk 1% of your capital, right? So it's relatively low risk if you follow the rules, all right? And I tell people that when you first start trading, do not trade with real money. Do not trade with real money. Always paper trade with a demo account first. And only when you can follow the rules without deviation, only when you can make money consistently, then you use real money. It's like a pilot. Before you fly the plane with live passengers on board, you get into the simulator and you fly, you take off and land 100 times perfectly, then you fly with real passengers. Understand? Same thing with trading. You can't do this in any other business. If you want to start a restaurant, you can't say, oh, I'm going to open a virtual restaurant in a virtual location, and if it works, then I open a real restaurant. You can't do that. All right? But in trading, you can trade realistically without using real money. Please do that. Because when you start, you will make mistakes. So may as well make all the mistakes with demo account, with virtual money, and then when you get experience, use the real money. Cool? Right? And trading is a skill that once you learn, no one can take this away from you. It is a life skill. Some people, they spend 50K, 100K going to university, getting a bachelor's degree, a master's degree, but that doesn't guarantee them a job. Because as we grow older, we can get replaced by someone younger, cheaper, faster, or replaced by AI eventually, right? But when you learn to trade, no one can take away this skill. For the rest of your life, you have a skill, okay? And like I said, when you learn how to trade, you can trade anything. You can trade futures, you can trade stocks, you can trade options, you can trade whatever you want, all right? Very, very powerful skill, yeah? So go ahead and enroll. Like I said, 70% off today, 1702.8, scan the QR code, click on the link and get started, okay? Now, let's see if there are some questions that people have that can help to answer. Give me a second. Okay, so cool. Market is sideways today, right? Is the market sideways today? Let me take a look. Market is, yeah, slightly up today. Yeah, just slightly up, about 10 grand today. Okay, so market goes up and down. All right. Okay, let's see any okay, Raw is asking, can you share the slide again if you want to be a full-time trader? Oh, which one? This one? Is this one Raw? Okay. Yeah, so this is roughly showing you that, yeah, I mean, if you trade and once you learn the skill of trading, yeah, you require less capital to get the same kind of trading income compared to, for example, putting into the bank, right? Yeah. What advice do you give to naked traders? Mohammed is like, what do you mean by naked traders? I don't understand what's the meaning of naked traders. You may want to elaborate, right? I hope it doesn't mean that you are really literally physically naked. If you are, please wear your clothes. How long should the trade be held if it does not hit 2R? Good question. So I will normally just leave it until it hits 2R or until the earnings results are coming. I will get out before the earnings. And company announce earnings every 3 months. So because of that, I will not hold it more than 3 months. I will get out before the earnings results. Jit is asking if the stock is 500 or greater, are you also using 3 cents to 10 cents? Well, if it's a $500 stock, you can use 50 cents. If it's like $300 stock, you can use 30 cents. Okay. If the share price keeps moving up, do you increase the take profit target? Normally I don't. Once I place the take profit target, I'll just leave it there. Because you never know, right? You know? Ethan is asking, I wonder if we don't have that much time every day monitoring the market opens late in my time zone, I don't have that much energy after work. Is it possible that we just set up the trades and not monitor the market? Yes, absolutely. In fact, the way I teach swing trading is we do all the analysis, we look for trades before the market opens. Before the market opens. And you may want to take 30 minutes to an hour, anytime before the market opens to look for the setup. You place your orders before the market opens. Once the market opens, you don't have to look at the market anymore. Why? Because your orders are there, right? Once it triggers your buy order, if it hits a stop loss, the broker will automatically sell and cut loss. Once it hits the profit target, it will automatically take profit. You don't have to be there to look at it. In fact, it's better to not look at the market when it's open. Why? Who can tell me why it's better to not look at the market when it's open, when it comes to trading? Why is it better? Because I can tell you that when you keep looking at the market, when it's open, you get very emotional, right? When it goes up, you go, yeah, you get very excited. Oh, you feel good. You hug your wife, you kiss your kids, you pet the dog, and then you walk around, suddenly, oh, the market's going down, you get upset, and then you slap the kids, you kick the dog, right? And you get very emotional, and then you don't follow the rules, and you start to shift your stop loss and shift the profit target, and you screw it up, right? So the whole point is it's better to not look at the market when it's open. That's why I think that for people like me who are in the Asian time zone and the US market opens when I'm asleep, most of the time it's good. Then I don't look at it. But if the market is open when I'm awake, then I get very tempted to look at it, which is not a good thing. It messes up your psychology. So the less you look at the market, the better it is actually. Okay? So that's the irony behind it. Azri is asking, how do you decide what stocks are identified for investment or trading? So stocks for investment, they must meet my 7-step criteria, which I taught on the first day, right? It must be a very good company, it must be the top 1%, must be undervalued, then I buy for investment. So I've got a portfolio which is just for investment. These are all my wives that I'm married, okay? But I also will trade stocks that are not the 1%, that may not be great companies, but if I think that it's going to go up or go down in the short term, I will trade it short term, okay? So like I said, stocks that meet my investment criteria, are very different from stocks that meet the trading criteria. Different rules. Okay. Do I use AI for trading? No, I don't. I don't see how it can work very well, at least not now. Is it a good time to trade with the coming US election? Doesn't matter. Doesn't matter election or war or whatever. That is all totally unimportant. As a trader, you don't read any of the news. You just look at the price action. That's it. Look at the Bollinger Bands, look at the price action, look at the double bottom, look at the 90 degrees, look at the candlestick. That's it. Don't look at all the news. The news is there to confuse you. John is asking, do I foresee AI to screen stocks for setup and execute them? AI has been around for a long time, but I've never ever seen any good AI system that can beat a human trader. How many positions do you advise students to hold per time? Jolene is asking. Okay, so Jolene, what I tell my students is never expose your account to more than 10% total risk. So if each trade you take, you're risking 1%, right? You should not have more than 10 trades. Okay, but if each trade you're risking 2%, then you should not have more than 5 trades. So your total cumulative risk should never be more than 10%. Joanne is asking, if I was to do a swing trade using options, how do I know which expiry date to enter? Well, it depends, Joanne, on which strategy. So if I'm entering using a bull put spread, which is what I taught yesterday, I normally will use 40 days expiration. But if I'm using a bullish synthetic spread, then it doesn't matter the time expiration, because a bullish synthetic spread has got zero cost. So whether I choose 60 days or 90 days to expiration, it makes no difference. The cost is the same. All right. And once it hits the profit target, I just close the trade, even if there's time left to the options expiry. Adam, how do you manage your emotions on trading? So that is what I'll teach you in the course, right? So there's a lot of tricks that I use to program in my mind to have no emotion. So when I have a winning trade, I'm not happy. When I'm losing trade, I'm not sad. Okay, because I know that each trade I take, the outcome is random. I will never know which trade will be a winning trade. I'll never know which trade will be a losing trade. I have got no idea because it is random. But I know that every 100 trades I take, I'll have winning trades, I've got losing trades, but the wins will cover the losses. So I train myself to trade in a Zen manner. Okay. How do I screen for stocks to buy? So Melissa, you can use a free screener using FinViz, which I showed you just now. All right. You can use the FinViz, the free screener. You can look for uptrending stocks using the channel up. Look for stocks that are in an up channel. So these are some of the stage 2, not all of them, but this can give you an idea of some on a stage 2, right? You can also screen for downtrending stocks. These are all on the stage 4, right? Downtrend, right? So you can use this free screener, okay? In the course, I'll also show you how I use advanced screener. This one is, you need to subscribe, not to me, but to this software, where I will use this screener with the screening scripts to identify uptrend stocks, right? That I identify using the screener. So in the course, you will get all these screening scripts to help you to find the trades using these advanced screeners as well. But if you don't want to use the advanced screener, you can use the free one as well. By the way, what is this called? My screener identified this stock. This is a stage 2 uptrend. Makes a high, same high, same high, same high, breakout. Can you tell me what setup is this? What setup is this? This is a breakout from base setup. Very good. Breakout from base. Good. There we are. Yeah. So this is my advanced screener. Okay. Jason is asking, what time to what time do you trade Singapore time? Okay, so usually what happens is before the market opens, anytime before the market opens, I will look for setups. And for me, it takes me about 30 minutes. Okay. Then then before the market, so if I'm trading the stock, before the market opens, anytime before the market opens, I'll place my orders with the broker. And then once the market opens, I don't even have to look at it. But when I trade options, then I have to look at the market when I trade options, because options, you can't place the orders beforehand. You have to place the orders live. And for that, I will usually spend in a day at the most about 30 minutes to 45 minutes, which is any time before the market closes, which is when I'm free. Okay, so the market opens at 9:30 Singapore time, 9:30 p.m. And so anytime, right? So if I'm free at 10 p.m., I'll do it at 10 p.m. If I'm free at 11, I'll do it at 11. If I'm free at 9:30, I'll do it at 9:30. So it depends on when I'm free. Okay, yeah. Mira is asking, what is the percentage I allocate for investing and trading? For me, most of my money is in investing, right? It's like 90% or more is investing and 10% is trading. That's for me. For Elson, it's the opposite. I think Elson is 90% trading, 10% investing. Bang Fan Ban is like 100% trading. So we're all different, and it depends on what you're more comfortable with. For me, I don't want to spend so much time in the market, so I tend to invest a lot more. Okay, great. So I think I've answered most of the questions. Last question, why do I stop day trading? Because number one, it is too time consuming. When you're like me, you have to spend a lot of time with your kids, your wife, your family. You got no time for day trading, number one. Number two, day trading is not as profitable as swing trading. The higher the time frame you go, the stronger the patterns, the higher the win rate. And for me, I like to trade options, because options, my win rate is 70 to 90%. And for options, you need to hold for at least 20 to 30 days. Right? So that's the reason why. Okay? Okay, so guys, I look forward to seeing you in the chat group. In the meantime, go download, grab the course, learn all that you can, and learn how to start trading. Take care, and I'll see you soon in the chat groups.